Now let's look at the last factor that affects the reserve balances at the Fed. However, these are not exhaustive and there are many more factors. So we've mentioned that the Federal Reserve Bank is the bank for the US Treasury. The main account in the balance sheet of the Fed is the general account. This is a type of checking account of the US Treasury maintained at the Fed. All checks issued by the Treasury are drawn on this account. Let's take an example of the tax refund as we've done before. Now, assuming that the Treasury needs to refund a tax amount of $1 million to ABC Corporation banking with Chase, when the check reaches the clearinghouse, the effect on the Fed's balance sheet will be to deposit the $1 million in Chase's account with the Fed and reduce the general account. So the liabilities on the Fed's balance sheet, the deposit of Chase's gets increased by $1 million and the general account gets decreased by $1 million. So the reserves and the monetary base both increase by $1 million. Money flows out of the general account that was not a part of the monetary base, flows back into the system. Any payment to and from the US Treasury will change the monetary base as well as reserves. So we can see the fluctuations of the general account, which are quite high. We see that the daily fluctuations in the general account with the Fed are quite high. So if the Treasury does not take steps to lower its impact of its operations on the reserve position, the reserve position would fluctuate wildly and therefore impact the Fed funds rate. The Treasury also keeps account at commercial banks called the Treasury Tax and Loans account to lower the impact of its operations on reserves. However, the federal government is not the only customer of the Fed. Foreign central banks, international agencies such as the World Bank and the IMF also have deposits at the Fed. Transactions through these deposits have the same effect on the monetary base and reserves as the general account. Now, for example, if the Bank of Japan purchases dollars, the Fed credits the account of Bank of Japan at the Fed. This reduces the level of reserves in the banking system. If the Fed leaves this reduction alone, it might impact the Fed funds rate. Now, all these operational factors affect the level of reserves. The Fed must determine the volume of reserves affected by these operations to determine the volume of open market operations required to negate the effects of these operational factors. And we've seen that these are sometimes called defensive open market operations. Now, here's a summary of the operational factors on the reserve position. So once the Fed calculates the amount it needs to add or subtract from reserves, it has the following options as tools. To increase the supply of reserves in the federal fund system, the Federal Reserve Bank can either outright purchase securities, which are permanent increases of reserves. It can repo or repurchase agreement. Now, the Federal Reserve has an option to conduct a system repo or a customer repo. The difference between the two is simple. If the Federal Reserve Bank is a counterparty in a repo transaction, this repo is called a system repo. If the Federal Reserve Bank is performing the repo on behalf of a customer, it is called a customer repo. The Federal Reserve Bank can also purchase internally from a foreign bank. Now, to reduce liquidity of reserves, the Federal Reserve Bank can sell securities outright, conduct a reverse repo, either a system or a customer repo, and a sale internally to a foreign bank. As we've mentioned, some of these transactions are permanent additions or subtractions to the reserve, while repos are temporary. When the Federal Reserve Bank purchases securities from the market or a foreign bank, it permanently adds reserves to the banking system. Essentially, as we have seen that when the Fed purchases securities, its assets increase and its liabilities, which are deposits of the bank, increases, increasing reserves. When the Fed performs a system repo with banks, reserves are temporarily added to the system. As the repo bank sells government securities to the Fed with a simultaneous agreement to purchase the next day, if it's an overnight repo, or it could be a term repo, which is a specific short period up to 7 days. So these adjustments of reserves are temporary, since a repo is a sale of government securities with a simultaneous agreement to purchase the next day. The price at which it is repurchased is higher to factor in the interest rate. The repo rate is generally lower than the Fed funds rate, since the repo is a collateralized debt as compared to the Fed fund borrowing, which is non-collateralized. Now we've seen that the customer repo has essentially the same effect as a system repo. A customer repo also adds reserves to the banking system. We have seen that foreign central banks have accounts with the Fed. For example, Bank of Japan would have a dollar account with the Fed of, say, $100 million to service its foreign exchange transactions. Since these funds of Bank of Japan are sitting idle at the Fed, Bank of Japan earns no interest. Bank of Japan then leaves instructions with the Fed to manage these funds to earn interest. The usual way would be for the Fed to simply repo securities between the foreign bank and itself. Another way that the Fed can facilitate this is for banks to sell securities to the foreign central bank, which is the Bank of Japan, with an agreement to buy back the securities the next day. The Fed arranges this transaction between dealers and the foreign central banks. So this is why this type of transaction is called a customer repo, because the Fed arranges this repo transaction for its customer, which is the Bank of Japan. Now, lastly, we will look at the final step that the Federal Reserve Bank takes in order to implement its monetary policy.